So hello and welcome to the Assay. Today I am happy to be joined by Guy Keller, Portfolio Manager at Tribeca Nuclear Energy Opportunity Strategy at Tribeca. So Guy, thanks so much for joining us here today.
Thanks for having me, Amy.
Always really great to catch up. I thought we could just start off with a very quick introduction to yourself and kind of, the Tribeca Nuclear Energy Opportunities Fund.
Sure. So the Tribeca Nuclear Energy Opportunities Fund is now in its 8th year. We launched this out of our global natural resources platform, which I'm a member of that team as well, because we looked at the investment opportunity starting on uranium back then, just on fundamental supply demand. Things were sort of looking up with respect to China, and we fast forward now, and of course China's still a very important part of the future demand for uranium for nuclear energy, but we've seen a huge amount of shift in the narrative in the last few years, or the last year in particular, around technology companies, data centers, AI, clean, reliable, firm baseload power, of which the only thing that ticks that with current technologies is nuclear. And countries like the United States, where obviously there's 96 odd reactors in operation, there's been a really big push there. So we've kind of seen the whole thematic now change from just uranium, kicking rocks and where we're going to find it and who's doing drill bits, to now nuclear technologies becoming very investable. So we're the only dedicated strategy in Australia, focusing on uranium and nuclear, and that's very important because there's a lot of stockbroker activity around some of the uranium stocks, but we're literally the only ones that also do downstream in nuclear, being generators and technology, and only one of a handful of dedicated investors around the globe as well.
Absolutely. I mean, it's interesting what you say about the change in the industry. I feel like even since we first started talking a few years ago, there's just the whole kind of discourse around nuclear has changed significantly. So I thought we could, look at the current state of the global uranium market. So looking at kind of supply and demand, and do you see a risk of a deficit in the near term?
Yeah, so I always look at it from a primary mine supply with respect to demand, and from that respect, we've had a primary mine supply deficit for more than a decade, almost 2 decades. What with the nuclear end users, being global utilities, have been extraordinarily lucky is that they've had a lot of secondary supply and inventory that's been available to them over the last decade plus. But as my teenage children work out, there's food in the pantry, but if somebody's not restocking the pantry, it eventually runs out, and that's kind of the situation we're getting closer to in the uranium market. We have not spent capital developing mines. We've only just starting to restart old mines that have been on care and maintenance. Greenfield supply is almost non-existent, and some of our more mature supply, being in Kazakhstan and Canada, is getting to the point where there's not much more wiggle room for extra capacity without a huge investment in capex.
And do you see money going into kind of growing that supply, or within junior miners or other companies that can potentially go and find that?
Yeah, look, it's been it's been interesting because there's been money and government incentives go into every other part of the fuel cycle except uranium. There's been utility focus and sovereign focus on every other part of the fuel cycle except uranium. There tends to be this naive view that the market will solve the uranium supply problem. And, we're sitting here at an $80 term price, which is actually not a true reflection of where sellers are looking to contract long-term supply. It's actually higher than that, but there's a lot of gaming around how that is made, and then a really dangerous obsession with this spot price, which is being pushed around. So, there's money. Investors are sitting safely or trying to be safe in names like Cameco and producers that are producing uranium that have got some cash flow. And as I said, we're not seeing any significant capital roll down the stack. We're seeing every time the thing pops, every uranium explorer developer raises capital, but that's sustaining capital. That's not significant capital to move forward projects, because quite simply the price is not high enough to incentivize any of that capital to move significantly towards solving that supply deficit.
What do you think? What kind of pricing would we need to incentivize that investment?
Well, it's interesting. we had the World Nuclear Fuel Market Conference down here in Sydney in June, and I was lucky enough not to have to get on a plane to see a bunch of US utilities, Asian utilities, some Europeans, some Middle Eastern, lots of fuel buyers, lots of fuel cycle people. And, I go back to that term price. It seems to be an unwilling conclusion drawn that they know they're not going to get significant supply at an $80 term reference, but they can't go and contract at $90 or $95 because their board members and their CEOs, who are not nuclear people, are seeing an $80 term price from the price reporters. So it definitely needs to be higher. I think the fuel buyers understand that, but it's kind of chicken and egg. They need it to print higher to give them the reason to then go and lock in supply. Flip side to the Chinese as well. The Chinese were down here in Sydney as well, and they were basically saying, we'll take any pounds. We don't care what the price is. 95, 90, 100, whatever, we'll take them. But of course, Western suppliers are hesitant because of geopolitical risks. They don't want to, they don't want to announce to the market that they've just sold all of their future uranium to CNNC or CGN or someone to have a government get upset with them. So it needs to be higher. Where that price is going to be, ultimately the market will decide. And if last cycle is anything to go by, it will overshoot a natural equilibrium level because activity breeds activity. So we'll just get that sort of rolling contracting as we saw last cycle, where the price moves and suddenly everybody responds.
Yeah, absolutely. And so, look, there's, as you mentioned at the beginning, there's been a lot of talk about AI and data centers and, the massive increase in energy consumption that comes along with this. So do you see this as kind of a significant driver for the growth of the industry?
It's massive.
The growth of demand?
It's massive, especially in the Western countries. In countries like China and India, the growth in nuclear power has been government driven. So the economics of industry don't necessarily matter as much. They're just wanting to secure, baseload clean electrons. Historically, what you've seen in the West is with deindustrialization, you've seen aluminium smelters in the US doing discounted electricity deals with utilities that are subsidized by state or local governments, because that aluminium smelter will employ 3,000 people directly and 10,000 indirectly. So, the utilities have not had any demand certainty or price certainty. Now what you're seeing, and as I said, it's happening in the rest of the world, but it's most obvious in the US because of the big tech companies that we all know and love to hate, or hate to love. You've now got 20-year deals with pricing that's double or more of the current wholesale price. So utilities are in a and you've got a government pushing for more and more and more, and trying to get rid of bureaucracy and red tape and green tape and everything. So these utilities are in a position they've not been in for decades, where they've got demand certainty and price certainty. What you're not finding yet is they're not passing any of that, even a fraction of that certainty, down into the fuel cycle. So again, they're hoping that governments will solve enrichment and conversion bottlenecks in the West, and
Mhm.
they're expecting that the market will solve the uranium supply. And it doesn't work that way, because I'm not going to give money as an investor to a greenfield project at a marginal price if I don't have some certainty from a utility that they're going to be there for 5 or 10 or 20 years. And I think that's the domino that still needs to fall in all of this, and why we're seeing such extraordinary price action in the
Mhm.
utilities and the nuclear developers, and not necessarily in uranium yet, is because that the utilities need to wake up to that, or the tech companies who are very well aware of what's required to run a nuclear power plant. They're not engaging in multi-billion-dollar contracts without knowing every nut and bolt and logistical movement. You may find that these global technology companies are turning around to the utilities and saying, "Hey, I've just signed a 20-year contract for you to supply me with, nuclear power, and I don't see you going to get the fuel. Go out and get it." So that may change, but something needs to change where the industry, the mining industry, has that certainty to be able to progress.
Do you foresee, say, the tech companies going directly to the mining companies on this front, such as they've done, kind of the auto OEMs have done with the various battery metals manufacturers?
Yeah, so until a week ago, or till recently, I would have said no, on the basis that a lot of those OEMs and gigafactories and what have you got a little bit burned, especially trying to chase the lithium
Mhm.
gravy train, and ended up committing to a whole bunch of projects that are now marginal at these prices. So I would have said no on that basis. However, what you've now seen more recently in the United States around MP materials and the US government getting involved, but more importantly, Apple now making a commitment there, that has led me to potentially be a bit more comfortable with the fact that they may get more directly involved. I don't think, because certainly the utilities, a US utility, does not want to end up owning a uranium mine. They kind of almost got their last cycle and
Mhm.
managed to wriggle out of it. And I don't think a tech company necessarily wants to own a uranium mine either. However, they're going to be a lot more creative and innovative with financial motivations to secure supply than a utility, because the utilities are just a different breed of the fuel buyers are a different breed of people. Um, so you may find that you see prepays or financing of mines or what have you to secure some of that. So yeah, as I said, if we hadn't, as a result of this MP material stuff, I'm getting a little bit more constructive that we may see an announcement there.
Interesting. And so I thought we could just look at the ASX market now. So, how are ASX listed companies positioned in terms of quality of asset, jurisdictional advantage, potential to really, bring supply to the markets, in your view?
Yeah, look, so I mean, in that June quarter here, some of those ASX names had a very strong price performance. There had been a lot of those names that have been heavily shorted as a percentage of their free float. In dollar notional, it wasn't necessarily a huge amount of money, but as a percentage of free float, it was. So they were topping the league tables, if you like, down here, displacing some of the lithium and lithium names that had been on the top of that table. And it's not really a table you want to be at the top of, to be honest. Um, and so we've sort of seen a revaluation there. What we've since seen is that we've got 7 odd uranium stocks in the small ords, which is the small cap universe down here. It's only 200 stocks in Australia, so in North America, I think it's 2,000 or 5,000 stocks or something. So 7 out of 200. being roughly 3 or 4% of that index is more relevant than the small cap stuff in North America. And Paladin's come back into that index. So you are seeing more eyeballs and small cap players because of the fact that Paladin's been demoted back into the small ords, and so that index weight is higher. But the volatility is still sort of killing people here, and the fascination with the spot price. But with respect to jurisdiction, you've got two producers, Paladin and Boss Energy, Africa, Namibia, and South Australia, two great jurisdictions. And you've actually got a reasonable spread. I mean, NextGen has a listing down here in Australia, so you get that turbocharged, mega project in the Athabasca with some jurisdictional news coming up towards the end of this year. Regulatory news coming up to the end of this year. And then you got a whole bunch of the stack sort of drops off. You got some greenfields and then a whole bunch of explorers. But it's not the depth of market that you see in Canada and the US. And so the larger institutions really, really struggle to get this significant and meaningful exposure, and which is why I think you see some of that volatility down here.
And I believe you mentioned earlier that there's definitely more, the market seems more favorable towards producers rather than kind of the early stage explorers. How do you think we get that interest into the explorers and kind of those companies that will really help to hopefully bring more supply in?
Yeah, so there's kind of two sides to that, to the answer here, and the first is the type of investors that are in the space. So in North America, we tend to see investors investing in uranium as a proxy to the nuclear story. So nuclear is in the back garden of the United States and Canada, so they understand those drivers. They're seeing the tech company, and what you've seen there is in the past, and so 2021, for example, when we had that sort of big meme trade spike, everyone piled into uranium stocks. What we've seen this time in North America is they're piling into the nuclear stocks. Because it's kind of a bit more technology aligned. You got Sam Altman, ChatGPT, Oklo. Yeah, we like ChatGPT, and that's a tech play. Great. We're going to invest in that instead of some, explorer in the Athabasca Basin, drilling to, 1,200 meters. And so that mania, if you like, or that exposure has gone away from uranium. In Australia, investors here, because we're not a nuclear country for a bunch of reasons that are just don't make any sense, we don't have exposure to that. There's not much nuclear in Asia either, so we tend to view it as a commodity. So what's the uranium commodity price doing, and how do I get that exposure in uranium mining stocks or explorers? And as a result, there's a long memory down here of investors getting burnt by the lithium trade. A lot of investors, yes, made money on the way up, but a lot got burnt on the way down, especially in the juniors, where they just couldn't get out. They got burnt a little bit in rare earths as the broker train, gravy train, sort of tried to get investors into that trade. Nickel has not been great trade for them. Gold has been underwhelming in the explorer space compared to owning the gold price. And so there's that hesitance down here to now pile into uranium, especially when the spot price is swinging around, up to $80, back to 72, and spot's doing this, that, and the other, and it's going to change the universe. Fast forward, if you've got a $90 spot price again, very different landscape. I think people are falling all over themselves to find the next exploration play that's going to 10 bag for them. But it's just not the sentiment there in the market at the moment, and there has been a few false starts. So I think investors down the stack are saying, you know what, show me this is real, and then I'm happy to chase it 30 or 40% higher than playing here, and because there have been, sadly, some graveyards.
Absolutely. And just to wrap it up, so I thought we could look at, looking ahead, what should investors be watching out for in the uranium space over the next, say, 12 to 24 months?
Yeah, that's I mean, that's a really good time horizon as well, because I always get asked the question, what's going to happen next month or next week? And the uranium market doesn't move that fast. For every quarter that we continue to bumble along here, that's another quarter of uranium being consumed and utilities being uncovered. That's another quarter of demand related announcements around either new capacity builds or uprates or more restarts or more deals. And it's another quarter of tech companies getting nervous, seeing utilities not responding to be buying fuel. So, we're in obviously Northern Hemisphere summer at the moment. We generally see seasonal uplift from September into the end of the calendar year from utilities. But the reality is, what the uranium sector needs to see is utilities starting to get busy in contracting uranium, and not just this short-term, opportunistic being in for small bits and pieces, but a start to significant contracting. You can't rule out, of course. I mean, we've just seen BHP out putting out some capex estimates on their Jansen potash project in Saskatchewan, where that capex has blown out significantly, and the timeline is that they brought in optimistically has gone back to their original timeline for first project. So that's obviously a big mining project in Canada, and there's some obvious candidates in Canada in uranium that are waiting for these regulatory hearings to potentially start their journey down final investment decision. So I think that's a little bit of a bellwether there to say, these big greenfield projects, you've got BHP who you should argue should be able to do things on time and on budget, blowing out. So some of these supply response expectations in the next 12 or 24 months, I think, are going to get pushed out as well, and become more expensive. So I think that kind of news is what you need to look for, and of course, a headline that that we don't expect, like the US government, going and sequestering uranium pounds, or a tech company coming in, as we discussed earlier. So that kind of non-fundamental news flow is always out there, and that's kind of your call option on this progressing quicker than it otherwise may do so.
Yeah, absolutely. Well, definitely quite a bit, it's an interesting time, and definitely quite a bit to keep our eyes out on. So those were all the questions that I had for you today, guys. So I really want to thank you for joining us here today at the Assay, and hopefully we can catch up sooner rather than later. Yeah, thanks for joining.
Thanks, Amy. I really appreciate it, and thanks for your time. And if anyone wants to reach out for any follow-up, please do.